Hey everyone, I have a really exciting video for you all today. I bought 3 new dividend stocks for 2021. The first is Hormel Foods. They make Spam. They also make Skippy peanut butter, along with many other brands in the meat aisle of the supermarket. I also bought Utz brand of potato chips. Here you go. These are some barbecue potato chips. These are delicious potato chips. This is a very fast growing company. And I also bought Church and Dwight. They make Arm & Hammer baking soda. What do all 3 of these companies have in common? They are all very high growth dividend stocks. And so this year in 2021, I am looking towards adding some growth to my portfolio, and I am doing it through these 3 stocks that now round out my portfolio as 50 dividend stocks. But more than that, I want to share with all of you in the video today my strategy, my strategic plan for my overall dividend stock portfolio. As you can see on the screen right now, my strategic plan involves a lot of components. I want to go through all of these today because this is how I construct a robust dividend stock portfolio that performs well over the long term, that can weather any storm, that is going to serve me very well with massive cash flow right now in the short run, which I'm already enjoying, and even more in the long run. So before we get started today, make sure to smash that like button and then go ahead and check in the pinned comment below and also in the description. My strategy, my flowchart that I just shared is free for anyone to download and follow along at home. I have a link in the description and pinned comment to the PDF file, and I am going to share the strategy today that is behind all of my dividend stock investing and how I am approaching 2021 and beyond. There are a number of insights in the video today. You do not want to miss this video. There will also be a part 2, so you want to make sure to subscribe to my YouTube channel. Happy 2021, everyone. Let's get ready. It is an exciting time. Let's talk about dividend stock investing. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, I want to jump right into the strategy, and then I'm going to get into some of the specific stocks, and I will discuss the stocks that I own throughout the video today and also in more depth in part 2 of this video series. And I want to share with you on the screen right now my strategy for dividend stock investing. This is a multi-tiered strategy, and what I'm going to do is I'm going to start at the bottom of the screen, and then I'm going to work my way up. So let's hone in first on the yellow squares, the yellow rectangles, if you will, at the bottom of the screen right now. And so the base of my dividend stock portfolio, the foundation of my dividend stock portfolio, the dependable foundation that is rock solid are these bond-like dividend stocks. Bond-like dividend stocks are typically dividend stocks that are not growing in terms of revenues very quickly. They're not offering a ton of capital appreciation. They typically offer a very solid starting yield, somewhere between 4 and 8%, depending on the stock and depending on the market. But honestly, they're not really growing that quickly. Some examples of these stocks are Duke Energy, Southern Company, and Universal Company. These are all 3 stocks that I own. The first 2 are regulated electric utilities. The third is a farming company in the sin stock space. And I have a funny fact for all of you, and this is going to be a recurring theme in the video today. When you ask a growth investor, what do you think about dividend investors? Most of them think that you ignore the rest of the chart that I'm sharing. This is dividend investors. The yellow rectangles, the foundation, the base of my dividend stock portfolio, these bond-like stocks. If you ask a non-dividend investor, what are dividend investors all about? A lot of these folks will point the finger and oftentimes kind of poke fun of a dividend investor. And then they'll say, yeah, dividend investors, it doesn't really work because they're just collecting this cash flow, but the stocks don't go anywhere. But they ignore the rest of the universe. They ignore the rest of the strategy. They don't understand that dividend stock investing is one of the most versatile strategies around because it covers all of the different types of assets, in my humble opinion. It allows an investor to have an incredibly well-rounded portfolio, which is exactly what I'm doing with my strategy. But if you ask a non-dividend stock investor about dividend investing, they oftentimes think that's it and that's all. It's stocks like Duke Energy, Southern Company, that grow very slowly but provide very stable cash flow. They think that's it and that's all. Now, one thing I want to point out on the screenshot right now is I also write down that there's examples of foundation bond-like stocks with optionality. One example of that is PPL Corporation. PPL Corporation is a regulated electric utility, but they're selling their UK division, and there's an opportunity that they get acquired, quite frankly, by another company. And so what I'm saying is, in the short run, it's a bond-like entity. It provides me a stable cash flow that is generally going to grow, most likely with the rate of inflation. That being said, there's this optionality where if they get bought out, the stock can jump in share price and I can make a nice profit very quickly. And so there's stocks like that. It's not a one size fits all. When I go through the video today, in each of these categories, there are shades of gray. There are different types of stocks. And I'd say PPL is one in that foundational bucket that does have some optionality. Now, keep in mind, a lot of traditional investors, they go out and they invest in bonds. I don't like to invest in bonds because dividend stock investing is my wheelhouse, and I can have bond-like returns or better with the types of dividend stocks that are in the foundation of this portfolio. Now, why do I have this foundation of my portfolio like this? I have that because I need cash flow in the short run. I use cash flow already to pay real bills in my life right now, which makes my life easier and more predictable. I don't have to work for that money because these stocks pay dividends to me while I sleep. And so having a foundation like that is important in my portfolio because I rely on cash flow right now. And quite frankly, even if I didn't rely on cash flow right now, I like this foundation because there's less volatility. That's the point of a foundation. It holds the portfolio solid. Now, what you see on the left-hand side of the screen right now are some arrows. What I have done in my portfolio historically is I automatically reinvest all the dividends. But these days I'm selectively reinvesting dividends. And what the point of these arrows is it's to illustrate that over time, cash flow from some of the buckets towards the bottom of the flow chart can be redeployed in terms of buying stocks higher up on the list. And so oftentimes I'm reinvesting dividends right now in PPL, for example, but at some point in the future, maybe I stop reinvesting dividends and I use the dividends from PPL to buy a stock that is in the next bucket on the list, which is that series of green rectangles, and we'll get to that in a minute. But that is the point of the arrows. It is to show the flow of money and how dividends can be used to flow money from less risky assets into more risky assets and to build the portfolio over a sequence of time. And so I would say overall, on the bottom, the foundation, these yellow bracket of stocks or bond-like stocks, in my opinion, how much money does it make sense to have in that bucket? It really depends, but I would say on average for a hypothetical dividend portfolio, just talking from my own experience, somewhere maybe around, say, 10-20% probably makes sense in those buckets. And I tried to scale the buckets in terms of size to give an illustration of size and magnitude and money deployed. Now, moving up the chart, what you see in the middle of the chart are these green rectangles. And green rectangles represent core stocks. These are my ride or die stocks if you've been here for a while on my YouTube channel. And by the way, make sure to subscribe. This is a really unique channel about dividend stock investing, and I have a lot planned, a lot in store for all of you this year. So please make sure to subscribe to my YouTube channel, and don't forget to hit that like button as well. And so what you see in the middle of the screen right now with these green rectangles are these core stocks. Now, foundational stocks, they're not really growing in terms of capital appreciation, but they throw off a lot of dividend income. With the core stocks, what you really have are bread and butter blue chip style companies that are growing at a steady clip. Typically speaking, unless they are bought on deep discount, like I was buying earlier last year in March during the crash during the pandemic, at that time I was buying deep discount on some of these stocks, and I did really well. I fared very well doing that. But in general, the opportunity to make a lot of money buying these types of bread and butter stocks is possible, but it's more of a predictable style of investing. Surely these stocks are growing the dividends quicker than the foundational stocks, the bond-like stocks. Surely these companies are growing their revenues and therefore the share prices, the earnings, which are reflected ultimately in share price, are growing over time. But it's not at a super rapid clip, but sometimes some of these stocks will surprise you. And so as you can see on the screen right now, in my core stocks, my ride or die stocks, there's a typical dividend yield of 2 to 4%, averages around in the threes. Most of the stocks in my portfolio fall in this core bucket, and these are the robust companies that provide a dependable and growing stream of dividend income. They provide an ultimate sleep well at night factor, and some examples are Johnson & Johnson, PepsiCo, McDonald's, Clorox, Starbucks, Procter & Gamble, 3M, and Realty Income Corporation. Now, obviously, I own more stocks than the ones listed here, but I'm trying to show a representative sample of the types of stocks that fit in these buckets. And so you can see, even in the core stocks, you have Realty Income, which is a real estate investment trust. You have Johnson & Johnson, which is a healthcare company. You have 3M, which is an industrial company. You have Starbucks, which is a restaurant, a coffee company, so on and so forth. You have representation from all of the major industry categories. And that's something else that to keep in mind is not represented on the flow chart today. But as I'm constructing a ecosystem of dividend stocks, I try to have representation from all of the industries. I try to have representation from different size companies, and I try to have representation from companies that do business all around the world, because I want a globally diversified portfolio that is representative of the entire world. And so that's something really important to keep in mind. Now, as you can see on the screen right now, most of my money, and it's hard to necessarily gauge based on, I had to right size the rectangles to fit all of the text and such on the screen, but most of my money in my dividend stock portfolio is in these green buckets. And in these green buckets, I would say, just speaking on average, maybe it would make sense to have, say, anywhere between 60 and 80% of my personal dividend stock portfolio at any given time could be in those green buckets. Now, keep in mind that there are also ancillary dividend stocks, and so these are kind of a byproduct of these core stocks. Core stocks is where I want most of my money. Core stocks is where it's just the best of the breed. It's the best companies in the world. Starbucks, for example. I was buying Starbucks in the $50 range back last year when the market tanked. It's now over $100. And so it is possible to make a lot of money in core stocks if you time the market right, if you buy when the stocks are on sale. But I'm just saying, buying Starbucks right now in the $100 range, I would expect over the long term more of a steady Eddie return at current prices. And so that being said, they're going to raise the dividend very quickly. It's going to provide a huge sleep at well night factor, and it's going to provide a great core to the portfolio with that dividend averaging in that 3% range. But what you see to the right of my core stocks are these ancillary stocks, which are also in green. Ancillary stocks are ones that are not quite as good as the core stocks. They're not the kind of, sometimes I do an exercise like, look, if I could only own 5 or 10 stocks, which ones would they be? Those are the ones that are in the core stocks. But obviously I own 50 stocks, and I love all 50 stocks. They're all great stocks. There's certain stocks that just don't quite make it to the core stocks. As you can see on the screen right now, some of those examples are like Campbell's Soup, General Mills, Walmart, Chubb, Wells Fargo, AbbVie. These are all great stocks, world-class stocks. They don't quite make it into the core stocks. They're ancillary stocks. I weight these stocks a little bit lower. I have less money in these stocks. When I said 60 to 80%, that covered the entire core and ancillary bucket. I would say within that bucket, maybe a 70-30 ratio of a weighting between 70 core, 30 ancillary would make sense to me. And ancillary stocks, I have a little bit smaller, but they're stocks I want representation to. They're great companies. They make a lot of sense. Now, as you can see on the screen with the ancillary stocks, again, typically they yield somewhere between 2 and 4%, average in the threes. They're just like the core stocks. And these are very close to core stocks. They just don't quite make the cut, but I cannot live without owning them. And so some of these stocks are honestly turnaround plays. Like Wells Fargo, I was buying it in the low 20s, now up at 30. Obviously, I was also buying it a lot higher before it tanked, but now it's a turnaround play. And AbbVie, I was buying that one in the 60s. It's now, I believe, over $100. And so AbbVie is a great turnaround play that I've profited very well from. And so sometimes in these ancillary stocks, and in core stocks too, but I see it a little more in ancillary stocks, there are turnaround plays that I like to invest in. And so sometimes with ancillary stocks, I just just want to limit exposure as well from a diversification and risk management standpoint. Again, you can see the arrows here and you can see the flow of money. For someone like me, I like to start with a foundation. Once I have cash flowing from the foundation, I'll oftentimes flow that cash up into core stocks. Once I got the core stocks flowing, I'll take some of that cash flow and flow it into the ancillary stocks. And then you can see even next to the ancillary stocks, I have cash flowing real estate. And so cash flowing real estate is not a dividend stock. I own Realty Income, which is a core stock, but I also invest in commercial real estate. I'm a commercial real estate developer. And I just want to mention here, while this channel is about dividends, something that is very closely related to dividends is cash flowing real estate. And so whether you're investing in single family homes, you're investing in condominiums and renting them out, you're doing duplexes, triplexes, for example, all of that would fall into this bucket. And it is something that can make a lot of sense in the dividend investing ecosystem. It's something I have exposure to, and I like having that diversification because different asset classes tend to perform differently in different markets. And a lot of these buckets that I have separated out on the screen right now, when one goes up, the other can go down. And again, I'm trying to build an indestructible machine here. I'm building something that can operate without a CEO. I look at what I'm building as a business, and I don't want to be beholden to any one industry, any one asset class, any one type of stock. But again, what is so exciting is, generally speaking, except a few exceptions on here, such as this cash flowing real estate, a lot of these goals of diversification, they can be accomplished through dividend stocks. And that's why I think dividend stocks are one of the most versatile asset classes around. And that's when, honestly, I think people say growth stocks versus dividend stocks. You'll see in a minute, there is no distinction. Dividend stocks can do it all. Dividend stocks can be growth stocks. Dividend stocks can be bonds. Dividend stocks can be core stocks. Dividend stocks can do it all. And so let's keep going. One thing I want to point out here is there are stocks that fall in between the buckets. And so at the bottom in the yellow, you have the bonds, bond-like dividend stocks. In the green, you have those core, stable, blue chip dividend stocks. But in between, you have stocks like Altria, Philip Morris, and BTI. I own all three of these. These stocks provide those bond-like yields, but they also provide a little bit more growth, more like a core stock. And so they kind of ride between the buckets. I would say with something like an Altria, it has some upside optionality as well that pertains to that particular stock. And so there are stocks that don't fit one particular mold. There are stocks I own that fit between buckets. And when I'm constructing my ecosystem of stocks, all of that makes sense to weigh in. So I want to keep going. Check it out on the screen right now. As I move up further on the screen, I have the red or kind of like red purple colored buckets. And what I'm going to start is on the left-hand side with the high growth dividend stocks. And so I started this video today with an example of what I'm doing this year. What I'm doing this year is I'm putting money into Church & Dwight, I'm putting money into Hormel, and I'm putting money into Utz. Obviously, I'm going to be putting money into a lot of different stocks. I think General Mills is a good buy right now, which is an ancillary stock in that core realm of my investing portfolio. But one area of focus that I am focused on this year is buying a little bit more growth into my portfolio. And so it does make sense in my dividend stock portfolio to have money allocated towards high growth. Now, these high growth stocks, oftentimes they don't trade for very reasonable PEs. Hormel, Church & Dwight, Utz, they all have higher PEs, but they also are growing very quickly. They are growing their dividends very quickly, and the companies have a lot of long-term prospects. They have a very good future. Now, will I be using the dividends on those stocks to pay bills immediately? No, it's going to take many years before the dividends grow enough for my yield on cost to be substantial enough to actually pay for anything. And am I buying those stocks on deep discount? No, I am not. But what I want is that exposure to the growth. What I want is to really take a look outward this year. I want to take a look outward, think about the future, and think not only about myself, but future generations. I want to just think about the long term. People are living really long lives these days. I plan to live a very long life. And so I just want to look 20, 30, 40 years out. These are the types of stocks that can really offer staggering returns, staggering yield on cost. And so for my dividend stock portfolio, how much exposure do I want in this bucket overall at the top, the high growth segment of this chart? Maybe about 10%, maybe up to 20%, somewhere in that range. And so as you can see on the screen right now, I start here with the high growth stocks, and they typically yield 1% or less. And a funny fact here is that a lot of growth investors, they're often surprised even to learn that these stocks are owned by dividend investors. When they think of dividend stocks, they think of Southern Company. They don't think of Church & Dwight. They don't think of Hormel. I have some other examples on here that I don't own, such as WD-40 Company. I covered this one. I wish I bought it. After I covered it, it went up a lot. Now it's a little bit too expensive for me, but congrats to all the dividend and growth investors that own it. RPM International, which is a stock that my good friend Sam from the community here alerted to me. Shout out Sam. He brought this one up to me in a meetup, and I did review this on my dividend in a video a while back. In fact, I will be linking in the description below to a variety of videos that complement this video, so make sure to check those out in the description. And as you can see on the screen right now, another example is Scott's Miracle-Gro, SMG. I will be probably analyzing this one in a future video. A lot of these high-growth dividend stocks, these are longer-term moonshots. They offer a huge ability for yield on cost, but right now, in the short run, they're not going to allow any dividend investors to pay the bills. But what I'm trying to illustrate here, again, is dividend stocks. It is such a versatile strategy. Your strategy may be different than mine. How you construct your portfolio may be different than mine. How you go about and orchestrate your ecosystem, it may have 50% in this bucket at the top. It may have 60%. It may have 100%. And so dividend investors of all different ages, of all different goal sets, of all different perspectives, unique life circumstances, the beauty of a dividend stocks is dividend stocks allow each investor to craft the portfolio that makes sense for them. Whereas I would say with growth stocks, generally speaking, they're more, these days at least with the high valuations, they're kind of in this top bucket. Some of those growth stocks, they're in that core kind of green bucket that you saw on the screen earlier, but most of them these days, a lot of them, the Teslas of the world, for example, they're up towards the top of this chart. And so what I'm trying to say is when some people say, compare dividend stocks to growth stocks, you can't really do that because dividend stocks, in my opinion, it runs a wider array of scenarios. It's just not comparable. And in fact, I've been comparing my portfolio a lot to the S&P 500. I'm very proud that in general, I'm keeping up with it and I'm doing it with less volatility, less max drawdown on the downside, and with a higher dividend component than the S&P. But can I really even compare what I'm doing to the S&P? Because a good chunk of my portfolio lies in the foundation, in those buckets at the bottom that represent bonds. And the S&P is a stock index. It's not a bond index. And so this is something really to keep in mind, that I should probably be benchmarking myself more across a kind of total returns, like world index that includes stocks and bonds, because that's really what I've constructed with dividend stocks. And it's something that if someone doesn't want, if they want something more comparable to a traditional stock index, they can eliminate the bucket at the bottom. They can go more towards the bucket in the middle and top and maybe even weight them 50-50. But that's the versatility that comes with dividend stocks. Let's keep going. And so at the top, what I also do is I draw an arrow to what's called these speculative investments, and this is optional. I have a few of these. I own Bitcoin, I own angel investments, and my wife and I own stock in companies that we used to work for that was granted via employee stock options. That's a whole different topic, but honestly, I have had great success. My family, my wife and I have had great success over the long term working at world-class companies over the years, getting equity in those companies and holding onto the equity for the long run. This is one of the reasons that we really do enjoy living here in California, because of the exposure to those high growth companies and the ability to earn through hard work to be rewarded with equity in those companies. And that's performed well. I would say that's a more speculative investment because a lot of these companies, they're on a very high growth trajectory. They don't pay a dividend, but keep in mind, this is the one portion of everything here that does not include cash flow. And so some dividend investors, myself included, will allocate a very small portion of the portfolio to these more speculative investments. And so I do own some angel investments, and I do own Bitcoin, which I purchased as the low point, 3,700, at the high point around 15,000. And so my average is, I believe, I forget. I shared it in a Patreon video. By the way, I'm on Patreon. If you enjoy the video today, you want even more content, I'm up to 17 bonus videos on Patreon. There's 110 patrons over there. I'm also sharing analysis there on Patreon. So if you sign up on Patreon, you support everything I'm doing here. You encourage me to produce more videos here on YouTube, and you get a lot of cool bonus content that gets unlocked immediately. So I will link to that in the description in the pinned comment below. And so let's keep going. And so one thing worth mentioning also is I list highly on there, HYLN. Shout out to JMac Investing. This is a SPAC that does not pay a dividend that JMac alerted me to. And this is something that I may buy this year. We'll see. This does not pay a dividend. If I do, any of the stuff in this speculative investments is very small, very, very, very small. Moonshot style allocations. And if you look at the flow of the lines on this chart, it all starts at the foundation, then it goes to the core, and from the core it goes over to the ancillary core and the cash flowing real estate. From there it goes back up to the high growth dividend stocks, and then finally speculative. And I drew these lines for a reason. One, to show that cash flow can be moved from one bucket up the food chain, but also just to show an order of events. For me, I need to always prioritize towards the core and then up later. And so that's just how I look at things. But anyways, let's keep going. Hyliion is something I'm looking at this year. We'll see if I go for that or not. And again, there are stocks that are in between the core and the high growth. Stocks like Apple, which I own, and Honeywell, which I own. These stocks, I would say, they're exhibiting a little bit faster growth than a core kind of stock, a core blue chip. And they're at high valuations, but they're not quite high growth stocks like an Utz Brands Inc. would be, or Church & Dwight or WD-40, one of those. And so that's why they're in between those two buckets. And so with all of that, I want to keep moving. I have more to share with all of you today. I want to talk about my overall 2021 dividend investing roadmap. And then in the next video, I will be going into specific stocks and also my specific watch list for this year. But I've got enough to cover today, so let's keep going. And so what you see on the screen right now is 2020. Let's just look at what happened last year. Last year was a year of looking inward. It was a shelter-in-place year. It was a year of uncertainty. The market was tumbling. And so what did I do? I focused on the core, and I focused on the core big. Actually, when I started the year, I was looking at those foundational high yielder bond-like stocks, but pretty soon when the market started collapsing, I had an opportunity to focus on the core, and I bought stocks like Starbucks at $51. I'm now up 101% on that tranche. I bought the Home Depot at $148. I'm up 86% on that tranche. I bought 3M at $125. I'm up 33% on the tranche. And J&J and McDonald's and others, I got really good deals as well. And so sometimes what is not illustrated in my overall diagram that I just shared is that even in core stocks, there's opportunities for huge returns if the market is timed right. And that's exactly what I did last year. It was a year of focusing inward, a year of sheltering because of the global events that were happening. But check it out on the screen. What am I planning for 2021? This is a year of looking outward. I'm looking outward. And I have a brand new office that I'm moving into right now. I'm so excited about that. I started swimming again in addition to my running. There's a little more certainty in my life because I know what I'm dealing with. Even though the global uncertainty is not solved, I understand what I'm dealing with. And so I'm looking outward. With a surging stock market, although a correction could be around the corner, and as a dividend investor who invests for cash flow, I always welcome a correction. I hope for a correction because I can buy my favorite stocks on discount. It could be around the corner, but right now, it doesn't seem necessarily like it's imminent, but we will see. I hope for one. But anyways, with a surging stock market, what am I doing? What is my strategy? My strategy is to really use this opportunity to focus on some of my smaller positions, some of my newer and expansion growth positions. And so I'm just focusing on the ones I just purchased. I'm focusing on the future. I'm focusing on the long term. I'm focusing on a bright long term. Now, obviously, I will be buying stocks in all of the other buckets that I shared today, and I'll share those in my next video, the ones that are on my watch list. But just as a strategic kind of check mark on my to-do list this year, I'm like, hey, Ian, build some new positions. And one of the other reasons I'm building new positions, I'm now up to 50, is by drawing a line in the sand. Starting a new position, it gets me excited and it gets me deploying more capital. And I think that's something that's really important on the psychology side of investing as well. So let's keep going. What else is in store this year? I'm going to remain flexible. If the market tanks, I'm going to go all in on ride or die stocks again. In the current situation, I will add to core stocks. And also what's exciting is last year, I finished a real estate deal that I had been working on for 4 years and we opened for business. This year, I'm working on a brand new deal. So again, I am looking outward. And so with all of that, I want to share just some final summary from the video today. Check it out on the screen right now. And what you see is my strategy. And so dividend stocks, as I mentioned in the video today, they do it all. Growth stocks are a portion of the pie, but they're not necessarily comparable. I think a lot of growth investors have dividend investing wrong because they don't understand the full picture. Comparing to the S&P is not necessarily the right thing. That being said, it's a good comparison just because that's what everyone compares to. And in general, I expect my strategy to maintain pace with the S&P by doing it with more cash flow and less volatility. My ecosystem of 50 stocks forms a well thought out business. I'm trying to illustrate today that I'm not just buying a collection of stocks. I'm actually comprising and building a complete ecosystem that forms a business. I am not only a part owner in all of these businesses, but the very compilation of all of these businesses is a business. And so I'm prioritizing cash flow, short and long term. I do what I do because I want to increasingly use more cash flow to pay my bills. I'm a dividend investor. That's the core of it all. And I'm building a business that will work even without a CEO, meaning remove me from the picture, it'll do just fine. And so sometimes investors here tell me, Ian, how do you keep up with 50 stocks? It's impossible to keep up with 50 stocks. The reason I'm able to keep up with 50 stocks is a lot of these stocks, quite frankly, are on autopilot. Whether I keep up with Johnson & Johnson or not, it will be just fine. Whether I keep up with Starbucks or not, it will be just fine. And in keeping up with all my stocks, which I do, it's so much easier these days with technology. A lot of people that are saying you can't follow more than 5 stocks or 10 stocks, it's because in the old days, like when Peter Lynch was doing all of this, he had to use a Quotron machine. He had to go out in the field to get market data. Now all the data is at our fingertips. I found it easy enough to keep up with the types of stocks that I own. More effort has to be placed higher up in the food chain, and so those stocks at the top of the food chain, like Utz Brands Inc., they require a bit more hands-on, delicate handling. And that's why those types of stocks, historically, I haven't had as many, but I'm happy to add a few of them to the portfolio, and I'm really excited about the prospects ahead in 2021. And so please, if you enjoyed the video today, if you enjoyed the free PDF that I shared, smash that like button. It means the world to me. And please don't forget to subscribe because I have many more dividend investing videos on the way this year in 2021. I love you all. In terms of a full disclosure, I own most of the stocks mentioned today. So let me see. I'm going to go through these stocks. I am long Utz Brands Inc., ticker symbol UTZ. Church & Dwight, ticker symbol CHD, Hormel Foods, ticker symbol HRL. I am long Bitcoin, ticker symbol BTC. I am long Apple, ticker symbol AAPL. Honeywell, ticker symbol HON. Johnson & Johnson, ticker symbol JNJ. PepsiCo, ticker symbol PEP. McDonald's, ticker symbol MCD. Clorox, ticker symbol CLX. Starbucks, ticker symbol SBUX. I'm going to need a Starbucks after doing this disclosure. I am long Procter & Gamble, ticker symbol PG, 3M, ticker symbol MMM, Realty Income, ticker symbol O. I am long Campbell's Soup, ticker symbol CPB. I am long General Mills, ticker symbol GIS. Walmart, ticker symbol WMT. Chubb, ticker symbol CB. Wells Fargo, ticker symbol WFC. AbbVie, ticker symbol ABBV. I am long Altria, ticker symbol MO. I am long Philip Morris, ticker symbol PM. I am long BTI, ticker symbol BTI. I am long Duke, ticker symbol DUK. I am long Southern, ticker symbol SO. Universal, ticker symbol UVV. Last but not least, I am long PPL Corporation, ticker symbol PPL. Please give me a comment. Show me some love below if you enjoyed the video today. Before I leave, also in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed investment advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Losing money in the market is very possible and very real, especially with our market at all-time highs. I love you all. I will see you in the next video.